All right. Welcome. Today, we're going to dive into one of Canada's most powerful, but also one of its most complex tax provisions for individuals, the capital gain deduction. My goal here is to really demystify it for you, piece by piece.
So, here's how we're going to break it all down. First, we'll get a handle on the basics, what the deduction is. Then, we'll tackle the two big limitations you need to watch out for. After that, we'll walk through a case study to see it all in action. And we'll wrap up with some bigger picture thoughts on what it all means.
All right, let's jump right into Section 1. We're going to lay the groundwork here and get a solid understanding of what this deduction is, who it's for, and what kind of property actually qualifies. Now, the very first thing you need to know is that this deduction is not a free-for-all. It's highly specific. It only applies to gains from these three types of property. And while farm and fishing properties are on the list, for our purposes today, we're really going to zero in on the one that affects the most entrepreneurs and investors, qualified small business corporation shares.
So let's talk numbers. As of 2025, if you're a resident of Canada, you have a lifetime capital gains exemption limit of over $1 million on these specific properties. That is a huge number, and it's not static either. It gets indexed for inflation, so you can expect it to creep up a little bit each year.
But here's the catch, and it's a really important one. That $1 million figure is the gain you can realize tax-free. In Canada, only half of your capital gains are actually taxable. So the maximum deduction you can take against your taxable income is half of that lifetime limit. For 2025, that works out to be $522,145.
Okay, so what does it take for shares to be qualified? Well, the corporation has to pass a pretty strict four-part test, and it has to pass it at the very moment you sell the shares. First, it has to be a Canadian-controlled private corporation. Second, pretty much all of its assets have to be used in an active business right here in Canada. And then you have these two holding period tests that look back 24 months to make sure the shares haven't been flipped between unrelated people and that the company's assets have been genuinely active.
This is a key piece of the puzzle and a common point of confusion. Claiming the deduction is completely optional. It's not automatic. You get to choose when to use it. And that opens the door for some really smart tax planning. You might choose not to claim it in a year where your income is low, and instead save that precious room for a future year when you expect to be in a much higher tax bracket. That way, you get more bang for your buck.
All right, so you have a qualifying gain. That's great. But hold on, we've just hit our first hurdle. The deduction isn't quite as simple as just applying it to your gain. We have to talk about losses first. The fundamental rule here is actually pretty logical when you think about it. The deduction can only be applied to your net capital gains. That means before you can even think about the deduction, you first have to subtract any other capital losses you might have, whether they happen this year or are being carried forward from past years. The system wants to see your overall profit before it gives you a break. And this example shows exactly how that works in practice. Let's walk through it. We start with a $40,000 taxable capital gain from our QSBC shares. But then, we have to reduce it. First, by $10,000 in other capital losses. Then, by a $4,000 business investment loss. And finally, we dig into our loss carryforwards and apply another $12,000. So, after all is said and done, that initial $40,000 gain has been whittled down to just $14,000 available for the deduction. Okay, deep breath. We are now heading into the second, and without a doubt, the most complicated part of this whole deduction. It's called the cumulative net investment loss, or CNIL. This is the rule that trips up just about everyone.
So what is it? Think of the CNIL as a running tab that the government has been keeping for you since way back in 1988. It's constantly tracking all of your investment-related expenses, things like interest you paid on a loan to buy stocks, or maybe expenses from a rental property, and it compares those expenses to all of the investment income you've earned. If your expenses are higher than your income over the years, that difference is your CNIL balance.
So why on earth does this complicated rule even exist? Well, it's all about fairness. It was specifically designed to prevent a very particular kind of tax loophole, a situation that's basically a form of double dipping. To get it, imagine this scenario. An investor borrows money to buy some shares, and over the year they pay $5,000 in interest on that loan. Then, they sell the shares for a capital gain of exactly $5,000. If you look at it economically, they're perfectly flat, right? They broke even. The gain was completely canceled out by the cost of financing it. Now, this is where it gets a little wild. Without the CNIL rule, look what could happen. That investor could use the capital gain deduction to make their $5,000 gain completely tax-free. At the same time, they could deduct the $5,000 of interest they paid against their other income. The result? They'd get a tax refund of $2,250 on a deal where they made zero economic profit. That's the exact problem the CNIL rule was created to stop.
So the CNIL rule steps in and says, not so fast. It reduces the amount of the capital gain deduction you can claim by the balance in your CNIL account. So in this example, you've got a qualifying taxable gain of $20,000, but you also have a CNIL balance of $14,000. That means the maximum deduction you can claim this year is only $6,000. The CNIL doesn't take away your lifetime deduction, but it does force you to delay using it.
Okay, we have covered all the theory, the basic deduction, the netting of losses, and that tricky CNIL rule. Now let's put it all together and see how these pieces interact in the real world with a comprehensive case study. This is where the rubber really meets the road.
So here's our individual's financial picture for 2025. We have a big gain on some qualifying shares, that's good. But we also have a loss from some public company shares. There's a rental loss for the year, which, as we now know, is going to affect our CNIL. And we also have their history. We know how much of the deduction they've already used up and what their CNIL balance was at the start of the year.
So how do we tackle this? Let's walk through it conceptually. Step 1. We net the gains and losses. That $280,000 gain minus the $40,000 loss gives us a net gain of $240,000. Step 2. Find the taxable portion. Half of that is $120,000. Step 3. Update our CNIL. The starting balance of $31,000 plus this year's $4,000 rental loss brings it to $35,000. And the final step, subtract that updated CNIL from our taxable gain. And there's our answer, a capital gains deduction for the year of $85,000.
Now, this slide might look a little intimidating. This is the formal, by-the-book calculation straight from the tax legislation. It's more complex, breaking things down into annual limits and cumulative limits. But don't worry about the mechanics. The key takeaway is that even though the path is more detailed, it's designed to make sure all the rules are applied in the right order, and it ultimately leads us to the exact same result, a deduction of $85,000.
Okay, we have been deep in the weeds of the calculations. Let's zoom out now for our final section and think about the bigger picture. Why do we even have this deduction, and what does its future look like in the Canadian tax landscape?
This quote from the source material really hits on a crucial point. The whole reason this deduction was created was to encourage people to invest in small Canadian businesses. But whether it actually works is a hot topic of debate among economists and policymakers. And because of that debate, the quote suggests that its future isn't guaranteed, which is something every long-term investor really needs to keep in mind.
And so that leaves us with this big, important question. We have this tax provision that's incredibly valuable for some, but it's also ridiculously complex, and its core economic purpose is up for debate. So, what is its future? Is it time for a major reform, or should we be thinking about eliminating it altogether? It's a fundamental question that Canadian policymakers and investors will have to grapple with for years to come.